Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your tax planner in the trenches, and today we're digging into Roth conversions done right and how to avoid the hidden tax traps. Converting pre-tax IRA or 401k dollars to a Roth sounds simple. You move money, pay tax now, and enjoy tax-free growth later. But the ripple effects can inflate your bill, nudge you into phase-outs, and even raise Medicare premiums if you're not careful. My goal in this solo episode is to arm you with a clear checklist. When a conversion shines, how much to convert, and where the booby traps live across your return. We'll hit brackets, Social Security, IRMA, ACA credits, business owner quirks, 5-year rules, and practical workflow. Let's start with the fundamentals. A Roth conversion is the taxable transfer of pre-tax retirement money, usually from a traditional IRA or a pre-tax 401k rollover IRA, into a Roth IRA. You'll include the converted amount in ordinary income this year, but the prize is compelling. Tax-free growth, tax-free qualified withdrawals, and no required minimum distributions for the original owner. That combo gives you flexibility in retirement cash flow and estate planning. It's also a hedge against higher future tax rates, whether from policy changes or your own income rising later. For families thinking multi-generationally, a Roth can be a cleaner inheritance. Heirs generally must empty an inherited Roth within 10 years, but distributions are typically income tax-free, preserving more after-tax wealth and making withdrawal timing less painful overall. So when does a conversion shine? 3 moments stand out. First, the bridge years after you stop working but before Social Security, Medicare, and required minimum distributions kick in. Your taxable income may be temporarily lower, letting you convert dollars at modest rates while shrinking future RMDs. Second, market dips. Converting after a pullback means paying tax on a lower value and letting the rebound occur inside the Roth. Third, years with large deductions or losses, maybe a business loss, big charitable gifts, or a spike in itemized deductions from medical or casualty events. Those deductions can soak up conversion income. Add in sabbaticals, career changes, or early retirement gap years, and you've got windows where the math can be surprisingly favorable if you plan them deliberately. Bracket management is the heartbeat of Roth planning. Instead of asking, should I convert? Ask, how much can I convert at a rate I like? Many retirees aim to fill the 12%, 22%, or 24% brackets, stopping before the next jump. Here's some good news worth knowing. Recent tax legislation made the current 7 tax brackets permanent, so you're not racing a scheduled rate hike the way earlier law once suggested. That said, don't get too comfortable, because the same legislation added a few new wrinkles that a conversion can quietly disrupt. There's a senior deduction for taxpayers 65 and older that starts phasing out once modified adjusted gross income crosses $75,000 for single filers or $150,000 for joint filers, and it disappears entirely above those bands. There's also a much higher state and local tax deduction cap, up to $40,000 through 2029, which can also phase out at higher income levels. Push your income up with a conversion, and you can lose ground on both fronts even though your marginal bracket didn't change. Don't forget state taxes either. A 5-10% state rate can turn a great federal idea into a mediocre result. Model all of these layers together, and remember, some states don't tax Social Security or Roth distributions. A conversion doesn't live in a vacuum. It stacks on top of your other ordinary income, and it interacts with capital gains. Long-term gains and qualified dividends ride on top of ordinary income to determine their rate. Push taxable income higher with a conversion, and you might bump part of your gains from 0% to 15% or from 15% to 20%. The 3.8% net investment income tax is another sleeper. Conversions increase modified adjusted gross income even though the conversion isn't investment income. Cross NIIT thresholds and more investment income can be hit by the extra 3.8%. Translation: the true cost of a conversion is the stated bracket plus whatever taxes you awaken along the way for your situation personally. Social Security adds another layer. Benefits become taxable based on your provisional income, which is half your benefits plus other income and certain add-backs. A Roth conversion increases that provisional income and can cause more of your benefits to be taxed, up to a cap of 85% of benefits. 2 oddities follow. First, as you move through the phase-in range, your effective marginal rate can be higher than your stated bracket because each extra conversion dollar may pull more Social Security into taxable income. Second, once you're at the 85% cap, additional conversions don't worsen Social Security taxation, though they still affect brackets and credits. The takeaway: if you're claiming benefits, model the phase-in math before picking a conversion size. Medicare IRMA is the surcharge few people see coming. Part B and Part D premiums use a 2-year look-back of modified AGI, and the thresholds are cliffs, crossed by $1 and you pay higher premiums for the year. A conversion at age 63 can inflate your age 65 premiums. Likewise, age 64 affects age 66. Planning moves include breaking a big conversion into partial conversions over years to stay under a tier, harvesting deductions to create headroom, or accepting one surcharge year in exchange for lower lifetime RMDs. If life events caused your income spike, retirement, death of a spouse, marriage, divorce, you can appeal with Social Security using Form SSA 44. Better yet, avoid that cliff up front with deliberate, bracket-aware conversion planning today. On the Affordable Care Act marketplace, your premium tax credit is reconciled to household income. Conversions boost MAGI and can sharply reduce or even eliminate that credit, creating a tax surprise when you file. In some ranges, one extra dollar can trigger thousands of dollars of repayment. If you're buying coverage with advanced credits, model before converting. Strategies include smaller, monthly conversions you can halt if income runs hot, timing a conversion for a month you already met the annual income target, or postponing until Medicare eligibility. Also review whether shifting deductions, business income, or capital gains across years can create conversion room while keeping you within your intended subsidy band. Never convert blind during an ACA year. Seriously model. Small business owners should check the qualified business income deduction interplay. A Roth conversion doesn't create QBI, but it changes taxable income, which affects two levers. First, the overall limitation. Your QBI deduction is the lesser of 20% of QBI or 20% of taxable income minus capital gains. If taxable income is the bottleneck, a conversion can lift the cap and restore the deduction, offsetting some tax. Second, the phaseouts. For specified service trades or businesses, crossing the threshold phases down, then eliminates the deduction. A conversion can nudge you into or out of those bands. Practical tip: run side-by-side projections to see whether the QBI change helps or hurts. Net results beat hunches. Include wage and UBI limits too carefully. Conversions often trigger estimated tax headaches. Avoid penalties by meeting a safe harbor. Pay in at least 90% of your current year tax, or 100% of last year's tax, 110% if your prior year AGI was high. Wage earners can boost W-2 withholding late in the year. Business owners can tweak quarterly estimates. A unique move for IRA owners, year-end IRA withholding. With a December distribution, you can withhold a large amount, and it's treated as if withheld evenly throughout the year, erasing earlier underpayment penalties. Just remember, withholding on a conversion reduces the amount that lands in the Roth. Many clients convert the full amount and do a small, separate taxable distribution for withholding to protect contribution basis and 5-year clocks. 2 5-year rules matter. First, for earnings in your Roth to be tax-free, you need a 5 tax year clock on a Roth IRA plus age 59-1-2 or a qualifying event. Second, each conversion starts its own 5-year clock for the 10% early distribution penalty. If you're under 59-1-2 and tap converted amounts within 5 years, penalties can apply even though tax was paid at conversion. RMDs add risk. Once at RMD age, take the RMD first. You cannot convert it. Backdoor Roth fans, Pro Rata treats traditional SEP and simple IRAs as one pot. Employer plans are excluded, and basis spreads across every conversion. Roll pre-tax IRAs into a 401k to isolate basis. Track basis on Form 8606 and match 1099-R and 5498. Before we land the plane, 2 planning angles. For heirs and the so-called widow's penalty. When one spouse dies, joint income drops, but the survivor files single, where brackets are narrower and IRMA cliffs lower. Smoothing conversions now can reduce future RMDs, protect the survivor's bracket, and leave heirs Roth dollars that still must be emptied within 10 years but are income tax-free. Workflow: run multi-year projections, set a target conversion band, execute trustee to trustee, update estimates or withholding, document document basis on Form 8606 and review the full return ripple before year-end. Tactics: charitable bunching or QCDs, partial conversions, and no recharacterizations. Measure twice. Business owners: coordinate with compensation and plan design. Red flags for professional help: IRMA proximity, ACA subsidies, complex QBI SSTB issues, significant IRA basis, big capital gains, or recent retirement. Thanks for listening to Tax Smarts Unlocked. I'm David Robson. If this helped, share it and consider a planning session to put numbers to your situation. Subscribe for updates on new tax rules and strategies.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.